Hello everyone, welcome back to EQSIS. We are happy to introduce another fundamental tool which help you to do valuations. As a long-term investor, when you buy a share, the price what you pay today should be appropriate. If not, you end up making a bad investment. Doesn't matter the company is good or bad, your investment becomes bad if your valuation is poor. This tool help you to compare two different companies with a lot of valuation factors. Let me quickly explain what this tool can help you to do. If you want to access this particular tool, remember it is publicly accessible. To find the link, you can go to descriptions. If not, go to Google and search HDFC Earning Yield Calculator. Hopefully you find the link. Let me show you what this particular tool and how it helps me to take a rational decision. Let me now introduce you this tool. In valuations, we have various factors. Earnings yield is one primary factor. Majority of investors does valuations. So we have made this tool in 5 phases to justify the earnings yield in various perspectives. As far as the phase 1 is concerned, on this particular page, you can make comparison by taking two different companies. What we're gonna end up getting is the time it takes to match your investment expectations. Let me briefly introduce here. Once you get into this page, you have options to interact with this tool by choosing two different companies. By default, it loads with Asian Paints and HDFC Bank. And the next, it actually gives you some detail about the earnings yield, PE ratio, dividend yield, and those metrics are important for you to make comparison. I will be doing one for you. And once you scroll down, here you can set your expected yield. See, as a long-term investor, I may have my return on investment expectations. Am I right? So what exactly your yearly yield that you are expecting? Because in long term, if a company earns which meets your expectation, then your investment will yield your expected returns. So you should first convey that, are you expecting 12%? Are you expecting 10%? You can interact here. And of course, the earnings yield can justify it by the growth rate. So I will be explaining this bit later, but you will have again a scope to interact to see how many years that this particular company takes to meet your expectations. So, and we will have a lot of visuals with respect to this. Let me quickly get started here. So by default, I'm making a comparison with Asian Paints and HDFC Bank. If you look at Asian Paints, the current earnings yield is 2%. It means the company is actually making 2% profit for the price what you pay today to buy the shares. I'm not talking about the profit margin. I'm talking about the earnings yield. It means today you are paying 100 rupees to buy the share, whereas the company is actually making only 2 rupees. Remember, if your expected return is 15% from the market, then this particular company in long term cannot meet your expectation unless it grows significantly. So, in order to meet your expectation, there is one more interesting factor that we need to justify, which is nothing but the profit growth rate. And this particular growth rate, we can take it in two ways. One, we can look at their historical growth rate and size of the company. So, as a user, you can also change the growth rate to see how long it takes to meet your expectations. Let me now give you another company, which is HDFC Bank. HDFC Bank is actually giving you the yield of 6.4%. But this is still short of my expectation because assume that I am expecting a 15% yield. So if I click here a 15%, if I scroll down, it tells me that if HDFC Bank continued to grow, okay, if HDFC Bank, because last 5 years growth rate is around 21%, okay, the profit growth rate is 21%. If HDFC Bank profit is continued to grow by 21%, okay, on a year-on-year basis, then it will take 5 years to meet my expectation. It will take 5 years to meet my expectation, where at that point in time, it will start making the yield of 15% for the price what I paid today. Okay, it means for next 5 years, it is not going to make the yield what I'm expecting, but after 5th year, it will start making that yield. And if it continue to grow further, then probably I may end up getting more returns than what I'm expected from this from a very long term perspective. But remember, by fifth year only, it can meet my expectation. Similarly, if I go back to Asian Paints, their last 5 years growth rate is about 8%. The 5 years growth rate is about 8%. And if it continue to grow 8% with the current yield of 2, then it takes so long, 27 years, to meet my expected returns of 15%. By any chance, if I want just about a 10%, it won't take so long, but still it takes 22%. Remember, by investing my hard-earned money in stock market, if I'm getting only 2% earnings yield, having lesser growth rate, then it very likely to be a bad investment. So as an investor, you should be one thing very clear, that are you investing in a good company? That's a fundamental factor, but that's not enough to be a good investment, because a good company with bad price can lead to a bad investment. So make sure that use this to rationalize it. Here you have a factor to justify, because sometimes people say that, Murugan, Asian Paint is growing by 8%. That is historical growth rate. But if you anticipate the growth rate to be a little higher, okay, assume that a growth rate is about 15%, it still take 12 years. And if a growth rate is about 20%, it still take 9 years. Whereas if you look into HDFC Bank growing the same 20%, it takes only 3 years to meet. So when you make a comparison here, okay, HDFC Bank with a current valuation has, a high likely to meet it. But if you look at ROCE, of course, HDFC Bank is a banking company where ROCE doesn't make much sense. You can look into ROE as a better way. But of course, you can make various companies to make side by side comparison. Now, let me look into another company here. Okay, let's look at Pidilite here, and let me compare this with ITC. Okay, I understand these two companies have complete different expectations, because if you look at the Pidilite, their earnings yield is 1.7%. It means for every 100 rupees you pay today to buy the share, the company is making only 1.7%. As a long-term investor, I'm not expecting anything from a market. I'm badly dependent on the corporate earnings. If I am such a disciplined investor, looking at this earning yield might surprise me. Okay, so in spite of that, why people are paying such a hefty price, why people are accepting the PE ratios of 57? Because the market is expecting too much of growth. Okay, and those growth have to be justified by their realistic numbers. So if you look at the Pidilite, the recent 5 years, the growth rate is about 12.6%. But if you want to increase it or decrease it, you can still do so. But if you look at the ITC, their growth rate is only about 5%. The ITC growth rate is only about 5%. Its earnings yield is about 5.5. So this helps you to visualize, how long it takes to meet your target returns. I hope this is very interesting tool which help you to visualize that how many years the company going to take to justify your expected returns based on the current market price. So if you see that you're paying too much, better you can avoid making that investments. But this is not how you conclude your valuation. This is just the starting phase. That's why I told you this is one of 5 phase. We will be having the second phase where I will be talking more about the growth rate, because everything is about the growth rate. By any chance, if you expect the growth rate is about 8%, it takes only 8 years to meet your expectation. So what decides the story? It's all about the growth rate. Am I right? So one aspect is earnings yield, the other one is about the growth rate. And in order to understand the growth rate of profits, we have to look into various aspects. That is what we will be talking about uh, the second phase. That I've introduced it here, what you can expect it from the second phase. And as of now, we made the phase one live. So this link must be available for you to explore. And if you have any questions, you can even ask a question. By any chance, if you're an investor, you want to talk about your stock and you want to get a personalized research report, you can get connected with us. My name is Murugan. I'm a SEBI registered research analyst, and take this video as a educational content. But if you want to have a professional advice from me, you can get connected. You find the links available here to interact with us. Wishing you all the best. Hopefully you find this tool very useful. make your comments count. So express what you actually identified using this. And by any chance you want to have a company which you don't find it here, probably, okay, let's say if I want to make a comparison with another company, let's say Berger Paint, okay, and you don't find a Berger Paint here, so you actually mention the company here and then make a request, okay, in a WhatsApp. You can send a request. So if it is in phone, it will quickly open and then send a button, and we will revert you back. Wishing you all the best and happy investing. Be sure and take rational decisions.